Enbridge forecasting higher core profit for 2026 and has raised its dividend as the Calgary-based energy delivery company is in pole position to capitalize on growing demand for liquefied natural gas. Let's go to Aaron MacNeil. He's research analyst at TD Cowen, and he joins us now. Thanks for your time.
Hey, Marilla. Thanks for having me on.
So Enbridge's forecast is actually below TD estimates. Where's the biggest miss, and what do you see as a disconnect here?
Yeah, so just a bit of nuance here. It is below our estimate on an EBITDA basis. We were right in line on a DCF basis or distributable cash flow basis. So, in terms of the money that they earn that goes towards the dividend or goes towards growth capital, we were in line. Our FX assumption was a little higher than their guide. Our expectations on a recovery in their mid-con pipelines were a little bit higher. And a couple other bits and bobs, but ultimately, from a distributable cash flow basis, they were relatively in line with our estimate.
All right. There are, according to the CEO, $8 billion in new projects entering service in 2026. Can you give us some insight on what that includes?
Yeah, there's a whole thing across a whole slate of projects across the platform. What I would say is they're sort of firing on all cylinders. They would have projects coming to service in gas transmission on the oil side, renewables, et cetera. So, and on the utilities piece, there's this sort of wedge of recurring spend there. So it really, for a company of Enbridge's size, it's hard to pinpoint things, but they would have, quite a bit coming in across the platform.
Is a lot of this to cater to U.S. power demand?
Yes. Yeah. Most of the gas growth that we're seeing with Enbridge and with others is in south of the border.
All right. Has the company positioned itself to benefit at all from AI data center build out or needs in the U.S. or in Canada?
Yeah, it would be more of a U.S. phenomenon. Obviously, they're with the Spectra acquisition in, I believe, 2017, they added a big gas platform to the business. They also acquired 3 U.S. utilities several years ago, and they would sort of have tentacles into those types of projects across their platform. Ultimately, they're not going to be building gas-fired power. Their, pathway to that market is mostly through building laterals to new gas plants.
We also, of course, have a memorandum of understanding between Alberta and Ottawa. New pipelines could be in play. Will this benefit Enbridge at all? We know that Ottawa's looking for private money to invest here. We haven't heard about private partners yet. But what do you expect, or how do you expect Enbridge to play into this?
Yeah, so first of all, Enbridge is not the proponent, at least not yet. While they would be very capable of building this type of asset, they have not put their hand up to build it at this time. And in fact, they've proposed several other expansions to their mainline, which would expand crude oil midstream egress into the U.S. For incremental volume growth. And so, today they're actually offering brownfield expansions to their existing assets, which are largely oriented south, not west. And, that they believe, and certainly the math would bear it out, that, those are more capital efficient projects to expand egress today. And so I think ultimately for Enbridge specifically, the risk reward, isn't there yet. I would say that of Enbridge and others as well. But to the extent that there was a new pipeline built, obviously that would be a competitor to the mainline, which is the largest crude oil egress pipeline out of Canada today.
You mentioned that it's not enough has changed yet for a company like Enbridge to get involved. What would it take? Because obviously Alberta seems very on board with doing what it can to bring a new pipeline about. Ottawa now seems on board to make it happen, to fast track it if there is interest. What do you think it would take to cross that line?
Yeah, and I certainly don't want to speak for Enbridge, but I can provide my opinion. Like the last 2 West Coast pipelines, one being a gas pipeline, the other being an oil pipeline, were both significantly above original cost expectations. The returns on those assets will not be originally as expected. Today, Enbridge enjoys a lot of opportunity across its platform in gas and oil, less so in renewables. And so this really becomes an opportunity cost discussion. And so, if they're enjoying high returns and other opportunities, and they can fill their growth requirements with those other lower risk capital light opportunities, it would be a tough sell to sort of convince them to sort of abandon that and go for a longer cycle, probably lower return, higher risk project. And so, while I don't want to propose solutions here, like ultimately the risk reward balance would have to change. Like the government could come in and backstop a specific return. Like that's one example. There are several others, but I think giving more certainty on returns, because today Enbridge does enjoy kind of high certainty to pretty attractive returns across its platform.
Got it. All right, Aaron, I appreciate you joining us. Aaron MacNeil, research analyst, TD Cowen today.